As you guys know, Warren Buffett is one of the greatest investors of all time. He has years of experience and results to share with all of us. That's one of the big reasons why his annual shareholder meetings are considered the Woodstock of value investing. Every year, thousands of investors go there to ask Buffett and Munger questions about investing and learn from their years of experience. Today we are listening to some of those questions that were asked by investors that went on to achieve great success themselves. Hope you enjoy.
Thank you. Bill Ackman from New York, New York. For the handful of AAA-rated companies, AIG, Fannie Mae, Freddie Mac, and MBIA, are under formal investigation for accounting shenanigans and are in the process of restating their financials. Like Charlie said before, I think of a AAA-rated company as an exemplar, a company that should behave with the highest accounting and ethical standards. My questions this leads me to are, how can investors comfortably invest in any financial service company when a decent percentage of the AAA-rated companies have false and misleading financials? And I guess the follow-up question is, why don't the rating agencies do some independent due diligence from an accounting standpoint so that they can help serve as a watch on this issue?
Well, financial companies are more difficult to analyze than many companies. I mean, it is more. If you take the insurance business, the biggest single element that is very difficult to evaluate, even if you own the company, is the loss and loss adjustment expense reserve, and that has a huge impact on reported earnings of any given period. And the shorter the period, the more the impact can be from just small changes in assumptions. We carry, we'll say, 45 billion of loss reserves, but if I had to bet my life on whether 45 billion turned out to be a little over, a little under, I mean, it'd be I'd think a long time. And you could just as easily have a figure of 45.5 billion or 44.5 billion. And if you were concerned about reporting given earnings in a given period, that would be an easy game to play. In a bank, it basically is whether the loans are any good. And I've been on the boards of banks, and that's, I've gotten surprises. It's tough to tell. It's financial companies. If you're analyzing something like WD-40, or See's Candy, or our brick business, or whatever, they may have good or bad prospects, but you're not likely to be fooling yourself much about what's going on currently. But with financial institutions, it's much tougher. Then you throw in derivatives on top of it, and it's no one probably knows perfectly what some of it, or even within a reasonable range, the exact condition of some of the biggest banks in the world. But that brings you back to the due diligence question of the agencies. You had very high grade, very smart, financially smart people on the boards of both Freddie and Fannie, and yet one was 5 billion and one was apparently 9 billion. Those are big numbers, and I don't think those people were negligent. And it's very, very tough to know precisely what's going on in a financial institution. Charlie and I were directors of Solomon, and Charlie was on the audit committee, and I forget the size of a few of those things that you found, but what wasn't found. And that doesn't mean that people below are crooks or anything like that. It just means that it's very tough with thousands and thousands and thousands of complicated transactions, sometimes involving the computations involving multiple variables. It can be very hard to figure out where things stand at any given moment. And of course, when the numbers get huge on both sides and you get small changes in these huge numbers, they have this incredible effect on quarterly or yearly figures, because it all comes lumped in. Those adjustments come lumped in a short period of time. So I just think you have to accept the fact that insurance, banking, finance companies, we've seen all kinds of finance company, both frauds and just big mistakes over time, just one after another over the years. And it's just a more dangerous field to analyze. It doesn't mean you can't make money on it. We've made a lot of money on it, but it's difficult. Now, obviously, a GEICO, where you're insuring pretty much the same thing, auto drivers, and your statistics are much more valid in something like that than they will be if you're taking something that like asbestos liability. You're subject to far greater errors in estimation. Doesn't mean that people aren't operating in good faith, but I would just take the asbestos estimates of the 20 largest insurance companies. I will bet you they're way off, but I don't know in which direction. And that's sort of the nature of financial companies. I wouldn't fault the rating agencies in terms of not being able to dig into the financials and find things that all of the companies that you've talked about have had big name auditors, and our auditors at Berkshire, how many hours did they spend last year? I don't know what it would be, probably 60, 70,000 hours. And I'm sure at other, if you take major banks, they're spending more than that. But, can they be certain of the numbers? I doubt it. Charlie?
Yeah. Warren is obviously correct that where you've got complexity, which by its very nature provides better opportunities to be mistaken and not have it come to notice, or to be fraudulent and have it not be found out, you're going to get more fraud and mistakes than you are if you're selling a business where you shovel sand out of the river and sell it by the truckload. Just as a business that sells natural gas is going to have more explosions than a business that sells sand, a business like these major financial institutions, by its nature, is going to have way more problems, and that will always be true. And it's true when the financial institutions are owned by governments. In fact, some of the worst financial reporting in the world is done by governments, and governments, institutions like government banks in China, etc. So if you don't like the lack of perfect accounting in financial institutions, you're in the wrong world.
Two things that I picked up after meeting you: bridge was one and golf was another. Yeah. I was never a good golfer, and it was an excuse to talk. It certainly wasn't about golfing. Whenever I see something, take these very low interest rates, even negative interest rates, I'm always thinking, boy, I'm looking forward to talking to Warren about that. One thing that's fun is you have a very optimistic view about things.
I think if I'm a sort of neutral in terms of optimism or pessimism, and I look at the facts around me, I look at what has happened in my lifetime. Put three of me end to end, and you're back before the Declaration of Independence was written. That progress in three lifetimes like mine it's mind-blowing.
Since I've known you, you've always been good at taking finance things and making them simple. Do you think that came naturally, or did you learn over time just answering questions about finance decade after decade?
I started teaching a course when I was 21 years old at the University of Omaha. I did that because I was terrified of public speaking earlier, and I'd taken a Dale Carnegie course, and I felt I just had to get out there and start talking. Standing up for 2 hours in front of a class helped me in learning to explain things.
Well, it's amazing how you've gone through market periods that are utterly different, and yet your basic rules about what to do remain unchanged.
Yeah, the rules work. They're not the easiest to apply. They won't tell you exactly when to buy or sell, obviously, but you'll never do anything stupid if you follow some fairly simple principles. When you get a chance to buy something of extraordinary value, whether it's a farm or an apartment house or a piece of a business or an entire business, the time to do it is then, and not worry about whether you could do it a little cheaper a month later or 2 months later.
Warren makes unique compensation agreements for the people who work for him. And having thought through, how do you incent good behavior? What's the best thing for the long term? I've learned a lot of how you think about compensation.
Basically, I want the paintbrush to be in their hand. And then when they paint something that they think is beautiful and I think is beautiful, I want to cheer like crazy for them.
Good afternoon, Mr. Buffett, and good afternoon, Mr. Munger. My name is Mohnish Pabrai, and I'm from the Chicago area. Mr. Buffett, I'd like to thank you for all your insights over the years. I'm especially amazed at the pace at which you answer my letters, point by point. I have a question for you related to circle of competence. I have a notion that both Mr. Munger and yourself understand the Kleiner-Perkins model of early-stage venture capital investing, and currently they're focused in the internet space extremely well. My notion is that I think it is well within your circle of competence to understand what they do, just like you understand your circle of competence to understand what they do, just like you understand what your managers at See's Candy or Executive Jets do. So the question is that with the internet, I think we're seeing a change that has not been seen in the last 500 years as humans. We haven't seen something that is as dramatic and as profound that's going to come upon us. If, let's say, a John Doerr at Kleiner-Perkins approached you and said that they were starting, let's say, $1 billion early stage or later stage internet investment fund that Kleiner would manage, would you consider that, would you consider participating in that investment to be within your circle of competence if it were offered at terms that looked attractive?
I agree with the first part of what you said. I mean, I'm not sure that it'll necessarily will be the most important thing in the last 500 years in the commercial world, but it could well be, and if it isn't, it's right up there. I mean, we talked about this last year and maybe even the year before. I mean, it is a huge development. But, and I would say that Charlie and I both understand the process of early investment / promotion probably as well as anyone. We haven't participated in it. There's certain things we don't even like about it, but we do understand it, right, Charlie? And I would say that no, we would not have an interest in investing in the fund. We do not necessarily regard the internet. There's no question, if you're in the early stages of promotion, and particularly if you've got a reputation as a successful in that, but in this case it wouldn't make much difference because the whole field has gone wild, you will make a lot of money selling to the next stage and the next stage and the next stage. But in terms of picking out businesses that are going to do wonderfully as businesses, not as stocks for a while, but as businesses, I don't think it's necessarily so easy in the internet world. And I would say that if you were to ask some very top names in the field to name the next 5 companies out of the chute, or the next 10 companies out of the chute, and predict that one of them will earn, say, the $200 million I used as a threshold 6 or 7 years from now, I'm not so sure if they gave you a list that they would name a single one. That doesn't mean they might not make a lot of money by being early investors in them because they sell out to the next group and so on. But in the end, they have to succeed as businesses. And if few will succeed as businesses, the internet will have a huge impact on the world, but I'm not so sure that makes it an easy investment decision. Charlie?
Oh, at least
that makes it an easy investment decision. Charlie?
Oh, at least it's not an easy investment decision for us, and that's what we're looking for.
Yeah, we will never turn our money over to somebody else. If we're going to lose your money as Berkshire shareholders, we're going to lose it ourselves, and we're going to come back and look you in the eye and tell you how we lost it. We are not going to say this game is too tough, so we'll give our money to somebody else. You can give your money to somebody else, and you don't need the intermediaries of me and Charlie to do it for you. So we get approached all the time. I had a call, within the last couple of days on something you would know very well about participating in some fund. They always have, it's always stage 1, stage 2, stage 3, and the idea is we get some more people to come in later at twice the price, and maybe the fact that our name is involved in it will cause people to pay even more and all of that sort of thing. We're not in that game, and we're not going to turn the money over to someone else to manage. It's your money. You gave it to us to manage. We'll manage it. you decide you don't want us to manage it, you decide who you give it to it. We're not going to be intermediaries on it. And if we don't understand something ourselves, we're not looking for anybody else to do it for us. The world doesn't work very well that way anyway. I mean, usually you end up in the hands of the promoters and not the hands of the people who really know how to make money.